Despite BP's oil spill liabilities, the company still has access to about $60 billion. So the question now is, why is BP trying to raise so much cash? We partner with the FT to bring you Lex on Bloomberg so that you can get a sneak peek at the Financial Times flagship column a day early. Luke Templeman joins us now from London. Luke, thank you for your time. Okay, let's just go back to the question I just asked, which is, with the oil spill liabilities, they are massive because of the ecological disaster in the Gulf. Still, BP has a lot of cash, and yet they're raising billions this week.
Yeah, that's right. Now, BP's estimated its oil spill liabilities to be about $30 billion. Now, to fund them, they've embarked on an extraordinary cash drive. We've seen this week they raised $5 billion in loans backed by future revenues. Now, if you add to this their asset sales, suspended dividends and their undrawn debt facilities, they have access to, as you said, about $60 billion in cash. And that's all before the $30 billion or so that they expect to generate this year from their normal operations.
All right, you called it an extraordinary cash drive. What is driving it? What's motivating it?
Well, they certainly have investments to fund this year, such as $7 billion for their Devon deal. But the balance sheet reorganisation seems to be more of a permanent shift to a more cautious future. Now, of the big oil companies...
What do you mean by that, a cautious future?
Well, compared to their peer group, BP has pretty aggressive leverage at about 21%. Now, that compares to Shell at about 17%, Exxon at about 5%. Now, with all this cash, if they can reduce their borrowings to about $15 billion, they're going to bring the overall leverage back down to in the middle of this peer group range.
All right, with this aggressive cash-raising plan that's currently on the table, what does all this mean for the general investor?
Well, investors should remember that decreased leverage usually means decreased returns. Now, for 5 years, up until the Deepwater Horizon explosion, BP had actually outperformed Exxon by about 25% and Shell by about 7%. Now, even though BP shares look pretty cheap at the moment at about 6 times earnings, it seems as though these threat of unknown unknowns has meant that they're now valuing security over profits. You know,
a moment ago we were talking about the cautious future. What about just the topic of perception for a moment as well? We recently saw pictures of President Obama, the first family, vacationing not too far from the Gulf region. What does that do to BP? I assume it would help the BP image.
Well, it certainly doesn't hurt, does it? No, President Obama went swimming in the Gulf. Now, this week, the appointment's just been made for the $20 billion escrow fund, and I think BP are planning to write all that off, but they'll certainly be thinking that if the president's going swimming in the Gulf, then they're hoping that if the water's clean enough for him, then the water's clean enough for a lot of other people, and perhaps it might be able to bring those numbers down. That's all a bit of speculation, but it certainly doesn't hurt their image.
Certainly doesn't. Luke Templeman with the Financial Times flagship column, Lex. Thanks so much. Good luck with your deadline. We'll be watching for it.